So a while ago, I said that once the channel hits 20,000 subscribers, I would do a public portfolio review. And that's where we are today. So friends and family, in today's video, I'm gonna be roasting my own portfolio. And before we get into the details and the holdings, let's go ahead and take a look at and talk about the overview, the goal, the strategy of the portfolio itself. And for what it's worth, the portfolio's dividend yield is 2.4%. It spits out about $1,400 in dividends passive income, okay? So the goal of my portfolio, it's titled the Dividend Compounders with Cheese. You have to keep that in mind, okay? Pay attention. And the goal, it's to reach a portfolio valuation of at least $800,000 in order to lean fire / barista fire and only work once or twice a week because I want to work, not because I have to. That's a clear distinction. And what's the strategy of the portfolio? How do I plan on achieving the goal? Well, it's by investing into compounders that outperform the market, but also high yield payers with a proven track record. See, the catch is I have very little active income. So I'm doing coast fire in order to reach my goal. So I'm participating in 3 styles of fire. So my YouTube, that's my active income. It's what I do 7 days a week, 24/7. It's all that's on my mind. I put in about 55 to 75 hours a week every single week. Now, in a good month, I earn about $500 to $600. When things are kind of slow and the algorithm says your content blows or it sucks, I get about $200. Needless to say, I'm not making that much money. So I need to use the capital that I already have, the portfolio that you see on your screen right now, in order to grow it bigger. So I have one goal, one strategy, and 2 methods in order to reach $800,000. As you can see, we're pretty far away from reaching the goal. And some of you might think that I'm contradicting myself because I'm 35, I talk about growth, I talk about dividends, and it looks like I'm running 2 different investing philosophies at the same time. And some of you might be like, why don't you just invest into the QQQ? Why do you do dividends? And to be honest, all of that is fair, but I'm not contradicting myself, okay? I have one goal and everything flows downstream from that. Right? $800,000 is the destination. That's the vision. That's the dream. The best way that I can describe it is, say the end result is the numerical value of 10. You can get there with a 5 plus 5. You could also get there from 8 plus 2, 9 plus 1. Does that make sense? So I actually have 2 distinct portfolios. So one is the Dividend Compounders with Cheese, and it has my utmost priority, aka my total return with an emphasis on CAGR. So it's my performance portfolio. And despite the name saying dividend, CAGR is the name of the game. And this portfolio is going to be full of high quality businesses that also happen to pay a dividend because they grow earnings, cash flow, appreciate in their stock valuation over long periods of time. So the dividends are not a requirement, but it's the cherry on top. About 90% of my capital is going to be focused into this portfolio, and I think that makes sense, right? Portfolio number 2, which is going to be in a future upload in a separate portfolio series, that's where the other 10% is going to be allocated. And it's where I experiment with higher yield, dividend growth, and passive income. Yes, knowing full well the trade-offs, because that portfolio's name is going to be Dividend Consequences. And the holdings look entirely different from what is in this portfolio, right? It has names like SCHD, Altria, and not because they'll make me rich fast, but because they build cash flow and psychological stability. Knowing every 3 months or every month, getting that passive income, that cash flow pouring in, dude, it's a really good feeling. And it almost feels like I'm getting a second paycheck outside of YouTube. But make no mistake, the cheese portfolio, the one that you see on your screen right now, it does all of the heavy lifting and most of the work, which is why I give it more cheese and capital. 90%. I will not deviate away from that. But fundamentally, I think both portfolio styles make sense, and every business that I own is predictable, profitable, and has a solid economic moat. So even though there's two portfolios, the holdings within both of them, they all are high quality, at least they are in my opinion, right? I might be biased because I'm invested into them. And by the way, I intentionally explained all of this on a very high level to open up the floor for questions. So you can write them in the comments section and I'll answer it in future uploads. I already have the scripts for the first 10 episodes, so more likely than not, I will be addressing almost every single question that you might have. Now, with that said, let's go ahead and take a closer look at the holdings that make up this portfolio. So the Dividend Compounders with Cheese portfolio valuation is about $60,000, of which $51,000 my capital invested into it. So it's up roughly $8,400. And to be fully transparent, I also do have capital on the sidelines from when I sold out of pretty big blue chip heavy hitters last year. I had to capitalize on the profits. Now, as I scroll down, just take a look at the names, right? You have the military stocks represented, you've got consumer staples, you have one pharmaceutical company, but instead of making drugs and vaccines for humans, they're in the business of helping out our dogs, cats, and livestock. I have a waste disposal company, and then of course, there's the trade desk, okay? So much like my 2026 top stock picks video that I just uploaded, I do not have the big AI names like Palantir, NVDA, and AMD. Now, I used to be invested into them, but I sold out of them, right? To seize the profits because I'm not trying to be a Debbie Downer, but I just felt very fearful of the AI bubble and the circular money loop that's happening, right? Like NVIDIA's money is going over here and that money's going over here and it goes right back into NVIDIA. It's just going in a circle. And once I saw that trend, I was like, you know what? I'll jump ship. But if there's a sell-off, if there's a market correction, I'll jump back in. So some of the other names include Microsoft, Google, and even Marvell. I sold out of all of them last year, and that's why I do have some gunpowder in the reserves, but I stand on the hill that there's more than one way to win in the stock market, right? Not everyone has to make money the exact same way. It drives me up a wall when people say the only way is to do QQQ, or the only way is to do Mag 7, or the only way is, you know what I'm saying? Because there's merit and there's cheese in almost every sector and industry if you invest into the best in class, or during market corrections, or during their market lows, and then they have their rebound rally like oil and gas. You can do it through BDCs, you can do it through REITs, and etc. And that's because all of us have different risk profiles, preferences. Some of us can handle and stomach volatility, some of us cannot. Some of us prefer passive income, some of us don't care about dividends. When you bake all of that in, you get a package that's very unique to what you prioritize, and that's what this portfolio consists of. And as you can see, I don't have exposure to SaaS stocks, right? Like Adobe, Intuit, Salesforce, which I sold out of Salesforce last year at $265 a share. I did not know that they were going to go down to $190, whatever that they are today. I sold out of them because of the whole AI bubble and my theory that the market was going to have a correction in 2026, and it's actually happening. Right? I didn't think that it was going to happen in January and February. I thought it was going to be somewhere around like May or June, mid-year. But with how crazy 2026 has been, I'm not surprised. But when it comes to the software stocks, I do want to make a statement, right? When you think about the cybersecurity players, fintech, and software stocks, dude, I think that sell-off is a little overblown. Because if you pull up and look at their valuations, some of them, their trading multiples are at like a 9. Whereas historically, it's usually around a 45 or a 50. So it's kind of crazy. And because of that, I think I will be jumping in pretty soon to the best-in-class software stocks that are vertically integrated into enterprises, the ones where you don't just pay for the software, you also pay for the security, the customer support, the ongoing updates. Those ones, I think, are better positioned to thrive in the age of AI, whereas some of the other niche software stocks, dude, I think they're doomed. Do you know why the software stocks are selling off? I've been doing some research, and it's because there's a lot of AI software companies that are being funded right now through venture capital and private equity firms that are going to flip the entire industry upside down and smack them right in the left butt cheek. And the narrative and speculation is that vibe coding is going to make all of these software stocks obsolete. And that's where it rubs me wrong. That blanket statement right there, I don't think every single software stock is going to suffer. I do think others will, but you can't say companies like Microsoft and Salesforce are going to fall the same fate as the ones that are kind of dingy, that were already unprofitable. Like those ones, they're screwed. What is vibe coding? Essentially, Anthropic, Claude, and some of these other stealth LLM companies that we don't even know the names of right now, you essentially say exactly what you want, and that AI will make the software that's unique and tailored to your specific needs. So the story goes, why the heck would we ever pay for Adobe subscription fees or Microsoft Office when we can have a vibe coding software create exactly what we need? And I'm like, do you really think every single ma and pa S&P 500 company, everybody out there is going to adopt that and just vibe code everything? You know what I'm saying? I feel like it's overblown. Certain stuff, absolutely. But for the big enterprise platforms that have a lot of proprietary data and are custom tailored to fit the needs of the organization already, do you really think they're going to want to jump ship? And besides, I feel like investors, hedge funds, and Wall Street, they're being really short-sighted. If they jump ship right now to hop into these AI vibe coding companies, you don't think they're also going to raise their prices in the future? So it's like a never-ending cycle of them killing themselves, right? And the reason why I mentioned the price increase is because they're insinuating that a company is going to jump ship from Adobe, paying them, I don't know, $150,000 a year in order to use the PDF licensing agreement, plus all of the creative suite. Instead, they're going to use the vibe coding software and pay only $1,000. But eventually, investors are going to expect higher margins and revenue growth from the vibe coding software, and so they're going to have to hike up their prices. So in the end, why did you jump ship from Adobe to this vibe coding software? You're going to be paying exactly the same amount of money. Except with the vibe coding software, you're missing out on all of the integration of apps that work seamlessly together, and not to mention the manpower and hours needed in order to get up to speed, to be efficient in using those products of that software suite. And now you got to learn all over again. I just feel like, as a guy that used to work in corporate America, it's overblown. So in my portfolio, I do not have exposure to the software space, but don't be surprised if in episode 2, I'm like, hey guys, this is why I jumped in. Here's the investing thesis, and here's what I'm thinking. And I always say this, right? Don't follow me into it, but it's what I'm doing to share my experience so that you can learn from my mistakes. Now, having said that, if you are a friend of the channel, then I think almost every single one of these holdings makes sense to you if you understand what I prioritize and the kind of investor that I am, right? I follow value investing, dividend growth investing, and a little bit of GARP, right? Growth at a reasonable price. Every single one of these holdings have a durable, robust economic moat, a resilient business model where they grow their revenue year over year, except for Target because they're closing down the unprofitable locations, aka the retail stores where there was a lot of theft. So they were like, okay, we're closing shop. You are not allowed to have a Target in Portland anymore. And so consequently, their top line is decreasing. But when they dropped to $80 a share, that's when I jumped in, right? You can see my cost basis is $83 a share. As for Target, a blue chip household name, the downside versus the upside for me, I was willing to take that risk. And I've only been invested into them for like a month, if that. I'm up 32% into the green. My only regret is not putting more capital into it. We also have names like Amazon, Procter & Gamble, and obviously Clorox. These are two companies that have a portfolio of items and supplies that will be here 50 to 100 years from now. We're always going to be wanting to clean stuff, disinfect stuff, or wash our clothes in the washer. So easily a buy and hold for me. And then we also have Progressive, which is one of the 3 S-tier insurance defense companies, and then up at the top, I used to have 3 military stocks, but I reduced it down to Huntington Ingalls and Lockheed Martin. This one right here, they're the manufacturer of the F-35 jet fighter planes, and they also have the Skunk Labs that do a lot of stealth projects related to drone technology. 50% into the green. With Huntington Ingalls, I truly think America is going to bring shipbuilding and manufacturing back to the U.S. because I think 99% of the world's ships are all manufactured overseas in places like France and places like Japan, Korea, China. And I think the U.S. is trying to bring that industry back, right? Because prior to the 1950s, I think 35 to 40% of all of the ships around the world used to be made here in the U.S. I don't know why we closed all of it and allowed it to go offshore, to go overseas. So the investing thesis is really easy, right? The United States Navy, United States Coast Guard, when you think about the carriers, destroyers, and the submarines, this company makes them, Huntington Ingalls. My total gain is 153% into the green. Pretty easy right there. The only one that I am really deep into the red, almost $1,000 negative, is the trade desk. Now, it might be too early to say that it's my worst investment ever, but needless to say, I've never experienced negative 35% into the red. Worst comes to worst, I've seen one of my holdings go down to like 20%, maybe 22%, but 35%, I think this is one of those times where I kind of wish I put a stop loss in it. That way, like if it's below 10%, automatically sell everything, but I didn't do it because my investing thesis, I still think it's intact. Nothing has changed from the last time that they reported their earnings 2.5 months ago. It's just been selling off day after day since then. And the investing thesis goes like this. Digital advertising prints cash. So when you think about Meta, when you think about Instagram, Facebook Marketplace, or Google's YouTube, or Amazon's retail platform, all those ads that you see everywhere, those guys operate in a walled garden. So when you buy ads through Facebook, you can only place those ads on Facebook, on Instagram. You can't place Facebook ads onto YouTube. Does that make sense? And for Google YouTube ads, you can only have those ads popping up on YouTube. Now, what makes the trade desk different is that they operate ads on the open internet. So we're talking about Hulu, Disney, Paramount, Peacock, Wall Street Journal, New York Times, and even Spotify. So they place the ads onto all of those various platforms. And if we take a look at their numbers really quickly, the reason why I jumped into them is because financially and fundamentally, I mean, right now, take a look at this. This is outrageous. Year to date, so roughly 5 weeks, negative 28%. Into the red. Past 1 year, 77% into the red. The reason why I jumped into the trade desk is because I looked at the numbers, I looked at the financials, and I looked at the trajectory of their business model. Dude, they're crushing it, right? You look at their top line, absolutely bonkers. Every year without fail, a double-digit increase. Take a look at their bottom line per share. I mean, there's highs and lows, but over the grand scheme of things, it goes up and to the right. Take a look at their balance sheet. They have $1.4 billion of cash on hand. How much debt? $375 million of debt. Okay? So if you pay off all the debt on the books, they still have $1 billion of cash left over. So they're cash heavy. What about their free cash flow? Their free cash flow is also growing in a trend that makes my head spin, right? Year over year, an increase of 30%. So by all regards, financially, fundamentally, and through their operations, they're crushing it. But I can also pull up another example. It's not unique just to the trade desk because they're also a part of the wider software stock sell-off. Because if you look at Duolingo, just the same, right? Their revenue is just as beautiful, double-digit growth year over year. And if you jump on over to their balance sheet, $1.1 billion of cash on the books, and the total debt is $97 million. So it's also cash heavy, and their free cash flow is just as beautiful, and their operations are crushing. But just like the trade desk, Duolingo year-to-date, negative 31.4%. So I figured because all of the numbers were superior and they're operating in a space that I feel bullish about, which is digital advertising, I thought they were undervalued. Because historically, their trading multiple, if we take a look at the ratios tab right here, their forward trading multiples usually around like a what? 145, sometimes 171, sometimes 43, 55, 64. As of right now, it's a 13.8. And that's why I pulled the trigger and I bought into them. Now, it might be early to say, but I do think this might end up being the worst investment decision I have ever made. But I don't want to think too catastrophically because my investing thesis is still intact. And I think the reason why they went on a landslide in 2026 is because they had the sudden transition of their CFO. The one thing that you have to understand about the stock market is when investors in Wall Street, they're not informed of a leadership transition 12 to 18 months in advance, they punish you harshly. Duolingo, exact same situation. A C-suite transition without anyone else knowing. Same with Disney, and most recently, same with PayPal. When you announce that your CFO or CEO is going to abruptly change, people start thinking the worst, like, oh no, there's accounting fraud. Oh no, they've been cooking the books. Oh no, there's a scandal that hasn't come to light yet. Sometimes, though, they're changing leadership because they don't like the trajectory of that leader's vision and they're not executing. So for me, a leadership change is not the end of the world. But for the trade desk, it seems like it is, right? So my lesson learned here, being this deep into the red, I'm not used to that. Every single time that I buy into a company, I usually see pretty good gains, right? And I'm not even trying to brag. It's because I'm very careful when it comes to investing. I'm not joking. If you were to only make 200 to 500 US dollars a month, wouldn't you also be very careful into how you allocate that capital? You wouldn't just randomly buy stocks, right? I methodically thought about it a lot, did my research, and in the end, I'm negative 35% into the red. The fact of the matter is, time and time again on this channel, you can pause this video and fact check me. I say that 99% of the people investing into the stock market, you have no business picking individual stocks. Most of us are better off investing into SCHD and SCHG and calling it a day. Just passive investing, dollar cost averaging every 2 weeks when your paycheck comes in. Just put a little bit towards those two ETFs, you're good to go. But for those of us that are venturing into picking individual companies and businesses, you have to understand the ramifications and the risks associated with that. But more importantly, what people lack these days is patience, delayed gratification, and the ability to think long-term, 5, 10, 20 years down the road. If your stock doesn't 10x or 20x overnight, you're pissed off, you're foaming at the mouth. You treat the stock market like it's a lottery. It takes time for the investments to do their job, to compound, to 2x, 3x. If you're expecting get rich quick overnight kind of money, this is not the channel for you. Go somewhere else. Go where the day traders live. This is not a day trading channel. Patience. Patience, my friends. And that's why I'm personally not going to sell out of it. I'm just going to wait and see what happens. If the ship sinks, I'm going to sink with it because I want to learn my lesson the hard way. Because I think right now it's short-term noise. Eventually, I think they're going to rebound or another company's going to swallow them up, right? Because they want to get into the digital advertising game. Who knows? And worst comes to worst, yeah, I'll lose everything. What, like $2,800? It'll suck, but it's an expensive lesson that I'll always be cognizant and be mindful of going forward whenever I feel like venturing off into companies that do not pay a dividend. So my lesson learned here is that if big tech's operating in your territory, the loser's ultimately going to be the small fish. So Google and Amazon, historically, they've only been operating ads in their walled gardens, but now they're also venturing into the open internet while undercutting the trade desk. From my understanding, the trade desk, they do charge more in terms of fees for the ad placement. So if you are Nike, if you are Tide laundry detergent, if you are Brooks running shoes and you want to run a marketing campaign, the trade desk will charge you more versus Amazon that will charge you almost no fees at all. And they're willing to undercut and they can lose money while they allow the trade desk to die by 1,000 tiny cuts. They can wait for their competition to choke out or bleed. And when it comes to big tech, we've seen this time and time again with every industry and sector that they venture out into. The other players in the crowded field, they start dying or dissipating. And that's because big tech has the resources, the brain power, and the time on their side and the margins to wait it out. They don't care if they're only operating with a 1% net margin, whereas with the trade desk, their profit margin is 15%. And for them, if that decreases, it hurts them a lot, their bottom line. But for Amazon, if they're operating with a 1% margin in digital advertising, that's a splash in the bucket because they're so diversified and it's such a big conglomerate that everything else makes up for it. And so to be completely honest with you, I feel really sad when I look at the trade desk because I feel like I made a huge mistake, right? And so that's why for those of you that are invested into Duolingo, Adobe, Intuit, S&P Global, or any other software company that's also deep into the red right now, I sympathize with you because I'm also seeing negative $1,000 in my portfolio. Terrible feeling. If we scroll up right here, United Health, when I bought into them during their dip in July and August, and then they had their inevitable rebound in October, I was in the green by $3,700. I didn't sell, right? And now they're falling back down to their lows of August 2025, and now I'm only in the green by $486. So with United Health, I kind of wish I would have sold out of them in October. I had no idea that in January they were going to fall off a cliff. I think if I sell out of them, I will regret it because I truly think it's a $600 stock in 2.5 to 3 years. So I'm going to stick it out. I know a lot of you guys already jumped ship. I will stick it out and you can watch the progress of them rebounding. I think they will rebound. It can't get any lower than this, right? Please reassure me. I mean, of course it could. United Health, for all we know, they could hit 200. They could hit 100. Just like in my weekly earnings video, I said if PayPal reports anything less than perfection, they were going to drop down to like $40 a share. Lo and behold, PayPal did hit $40 a share because that's what I saw in the technical analysis indicators. So if you're invested into PayPal, Adobe, Intuit, and you're also feeling sad, I'm right there with you. Terrible feeling, but for me, the investing thesis is still intact. So we'll see what happens when they report their earnings at the end of February. I'm going to say it right now. If it's really gloomy and it's ugly and it's hideous, I will jump ship and take a whatever loss. They'll probably drop even further after the earnings. And so I probably would be selling $1,500 in the red, which is going to suck, but that's also going to propel and motivate me in order to make more gains in 2026 in order to make up for it. A really bad trait that I have is I always focus and prioritize and emphasize my losers, right? Because I could also be like other people and only think about Huntington Ingalls, only be thinking about Lockheed Martin. And by the way, the third military stock, remember I said I used to be invested into 3, but I sold out of 1? It was Oshkosh Corporation. I sold out of them at their all-time highs, right? There's a lot of things that I could be happy about, but I always choose to focus on the small percentage, the Pareto's principle, the really small portion of my portfolio that's deep into the red. And I feel like that's something that I want to overcome this year because it negates all of the good that's happening with the gains that the other holdings are making. And it's kind of like, well, what about us? Aren't we doing something magnificent here? All you care about is the trade desk being in the red. And it's like, yeah. Now, having said that, the reason why I should focus on the positive is because if you take a look at the performance of the portfolio up against the S&P 500, which is the benchmark that I want to compare myself to, because the priority, as I mentioned, is CAGR, total performance. I want to see my portfolio 2x or even 3x that of the S&P 500, which is why I do not do passive investing, which is why I don't just set and forget into VU, which is why I actively pick individual stocks, because I think the math speaks for itself, right? So my total return in the past 1 year, the Dividend Compounders with Cheese portfolio, including the $1,000 loss from the trade desk, is 39.8% into the green. The exact same time period, the S&P 500 is 17.8% into the green. So if you take a look at the highs and the lows, I have practically beat the S&P 500 consistently. Now, if I didn't have the trade desk in my portfolio, I think this number would have been much higher, maybe even 45% total return. But it is a learning lesson that I am willing to suffer at least for the next 3.5 weeks. So let's talk about Why do I do it this way? Why do I have two different portfolios? Why not keep it simple, stupid, KISS, right? Because CAGR gets me to the goal faster of $800,000, and dividend-paying businesses, well, they pay me rent along the way, right? Because if I invest into a non-dividend-paying growth stock like the Trade Desk or Adobe, or for instance, Hims and Hers Health, while they go up and down the volatility, I get nothing to show for that. Depending on when we take a snapshot of the portfolio, I could be 34% into the red, right? But if I were to get a dividend every 3 months, that would lessen the blow and reduce the total return being so drastically into the red. So while the market does its little dance of going up and down, by getting those dividends, it helps cushion the blow, but it also improves the CAGR. Microsoft, Google, Apple, NVDA, they all pay dividends. I consider all of them to be dividend compounders with cheese. Case in point, I think what makes growth stocks so crazy, with the example of SMCI, they just reported their earnings, they absolutely crushed. Their revenue was up by like 115 or 117% year over year. In the span of 365 days or 1 year, the stock will go up and down, up and down, up and down. Correct? But when it's all said and done, at the end of that 1 year period, they're in the green by 10%. But if you buy into them right here at the beginning of the year and you sell out of them at their peak, 92% into the green, right? Or if you sell out of them at this peak, if you sell out of them at this peak in October, you're also 100% into the green. But if you just buy and hold and do nothing, negative 5.7%. So what I'm trying to say is with growth companies, they will go up and down, up and down. Because they're categorized and defined as a growth company, they have a lot of beta, a lot of volatility. So I would rather get a dividend payment as they go through these ups and downs, the peaks and valleys. Perfect scenario, I would sell out of them when they go near the peaks. That's just what I would prefer to do. But if you just buy and hold, which is the mentality that most people have, which I think is good and admirable, wouldn't you also like to get a dividend while they go up and down, up and down? That way, it's not just a 10% green total return, but it could be potentially 13 or 14% because of the dividends. Now, having said that, I do not feel bullish about SMCI. I just do not think they have an economic moat. And when I listen to their earnings, their margins are actually decreasing year over year because of fierce competition from HP and Dell, because they're also making data server racks. There's nothing that SMCI does better. They do not have a competitive advantage or a differentiator. All that to say, that's why I run two different portfolios. And the high yield payers that are in my dividend consequences portfolio, they're basically my bonds with the potential of capital appreciation. So not only do they pay like a 5 or a 6% yield on cost dividend, but they also have the potential to go up in share price appreciation. So I think it's a win-win situation. And that's why I do dividend growth investing in a nutshell, but I do have a dedicated episode of like 7 different reasons as to why I do dividend investing for the purposes of CAGR with low volatility. That episode will drop soon, don't worry, okay? But it also ties back to my limited capital dilemma. So even if I upload more videos on YouTube, each video populates about, $4 to roughly $9? And I only have a finite amount of time every week. So I can crank out more videos to get more money, or I can allow my investments to pay me dividends, right? This portfolio, once again, the priority is the CAGR, but it still gives me $1,400 in dividends per year. You don't think I'm going to be using that money to reinvest and buy more stocks on the dip? A high quality company that's on bargain discount? That's absolutely what I'm going to be doing. So if you think I'm wasting my time by doing dividend investing, think about it, man. The dividends are paying me that second paycheck that I alluded to earlier so that I can buy more stocks. And as I buy more stocks, it allows the compounding nature of my portfolio to just grow bigger and bigger and snowball. Now, as I get older, I'll probably contribute more towards the dividend consequences portfolio in lieu of the cheese portfolio. But for the time being, while I'm still in my 30s, I'm 35, this is going to get 90% of my capital allocation. I think once I reach my 40s, it'll be 80-20, and then roughly 70-30. And then as I get closer to retirement, like as this portfolio reaches $700,000, it'll be roughly 70% of the capital going into dividend consequences, and then 30% going into the cheese portfolio, if that makes sense. And then eventually, I don't know if you guys are going to stick around until then, I'm going to transition everything in the cheese portfolio into the dividend consequences portfolio, because to survive and live off of $800,000, you sure bet that I'm going to maximize the dividend yield output. That's also going to be coming up in a future upload on how I plan to make that transition. But having said that, what makes me giggle is that some people think that you gotta pick one or the other. You gotta go all in with growth or all in with dividend investing. And for me, it's like, why not both? I see merit and I see the benefits and value add to both schools of philosophy. And I think they both work. So that's why I choose to do both. The good news for you is that both of my portfolios are going to be featured on the channel in an ongoing series for free. It's not going to be behind a paywall. You'll be able to follow the updates for the dividend consequences portfolio that's going to be coming up soon, but also with the cheese portfolio. Now, if you want the real-time transactions of like which stocks that I'm going to be eyeballing and buying for this upcoming week and everything else, only going to be on Patreon. Whereas on YouTube, you'll see everything happen after the fact. But I still think it's going to be value add, because you'll learn my thought process and my strategy and my thinking as to why I bought into something and why I decided to sell out of it as well. So having said that, I'm pretty excited to share my journey with y'all as I test if Coast Fire actually works or not in real time. Like that we'll be able to see, right? Like, can I actually retire and reach 800 grand with a portfolio that's going to be doing all of the heavy lifting instead of me contributing the money to do the heavy lifting? And based on my math, it should work out. By the way, that's also in a future upload, my math of how I'm going to turn this into $800,000 and the steps that it takes to get to that point. So what can you expect in the future for the series? In each episode, I'll go over FAQs, the comments that you leave on this video, and of course the updates to the positions, which ones I'm adding, which ones I'm selling, and just overall portfolio strategy tips. And also the conversation around FIRE, right? Financial independence, retire early. So if you appreciate the content, dude, I would love your support on the Patreon, where you can directly support the channel. If not, just watching the video all the way through, I greatly appreciate that you took the time to hang out with me. With that said, I love you, stay safe, good luck in the stock market, and tell me what you think of the Dividend Compounders with Cheese portfolio. I'll be honest with you, I'm not in love with the trade desk. Okay, I'm not in love with it, contemplating whether or not I want to cut my losses and take the L. Also, not really in love with Target, but it falls into my contrarian rebound rally play, and it worked out 32% into the green. So I guess before I head out of here, I should tell you my favorite positions: Huntington Ingalls, Lockheed Martin, no doubt in my mind. If there's a market-wide crash or a sell-off, these are the two positions I am adding to immediately. Another one that I really like is Amazon. What I don't like is that there's no dividends, but I think in the future, they're going to initiate a dividend, no doubt in my mind. And then these three right here, Clorox, Procter & Gamble, and Waste Connections, love them. The other ones, I'm okay if they're not in the portfolio anymore. Okay, I'm rambling now, so I'm gonna edit this video and get it up on the channel.